Hey, howdy, welcome y'all to the Bitcoin Mining Pavilion 2024. Gather round, come on forward. We're going to have a great program of different speakers today. My name is Steve Kennard. I'm the Director of Policy for the Texas Blockchain Council. We're really honored to be a co-sponsor of this with NAPE. I want to thank NAPE for this opportunity to bring this kind of unique programming to you. The Texas Blockchain Council is a nonprofit industry association. Think of us as a chamber of commerce. And a quick story I want to tell you is about my background and how I ended up being up here talking to you. I'm an oil and gas professional by background, was going to NAPE since 2013, was a former Houstonian. I live in Dallas now. And I heard about Bitcoin mining in the oil field, and I didn't know anything about Bitcoin, but I had personal prior experience with stranded natural gas that we had to flare. I also had experience with gas where there was only one pipeline, the only show in town, and you know what that does to your pricing that you receive at the wellhead. And so I realized if we can find another way to market natural gas, that has a huge future. In addition to that, the more I've worked with Bitcoin miners, I realized Bitcoin mining essentially is an energy business. It's about finding energy resources and optimizing their value. Oil and gas companies are about finding energy resources and optimizing their value. And that's why we're here today, because these two industries really work together. I think there's a future that's fast approaching where pretty much any time you've got natural gas production, one of the options on the table to make your business more efficient is going to be Bitcoin mining. And so as that question comes more and more, it's important that we bring more experts that can talk about that and really pave that road, because the future is bright and a lot of you that are standing here can be a part of that. I encourage you to ask questions, and I'm really fortunate to be a part of this. I want to go ahead and thank our two sponsors, Crusoe and Weaver. This wouldn't be possible without them, and we're fortunate that one of those sponsors, Weaver, is represented by Tim Savage, who's going to be your first speaker today to talk about the important topic of the tax implications of actually launching a Bitcoin mining operation. So Tim, come on up, and thanks so much.
Thank you so much, Steve. How's it going, everyone? Lovely to see your bright and shiny faces here at NAPE. First of all, I just want to say thank you to the Giga, Choya, Martin Group, and Unchained Capital for putting on such a great event last night. I had a good time, so good that I woke up this morning at my hotel room and kind of forgot where I was. So it's a sign of being happily intoxicated. Okay, so off-grid mining, accounting, and tax. I'm glad I'm going up first because it can be a pretty technical topic. I'm going to try not to get too technical and put you to sleep. It's only 20 minutes anyways, though, so it shouldn't be too long. So introduction, I'm Tim Savage. I'm a tax partner at Weaver, and I run our digital assets practice. My background, or really my career, started at Ernst & Young, one of the big 4 accounting firms, and really even before that in Abilene, Texas, working with this guy, Tyler Barnett, CFO at a oil and gas company. And I worked with banks and private equity companies and didn't really know anything about this whole Bitcoin thing until about 2017, when I really studied it and studied the economics behind it, studied macro theory, monetary theory, and kind of realized, hey, this is really an interesting asset. So fast forward to today, and I'm leading this practice at Weaver, where we focus on serving really 3 key industries within the world of digital assets. Primarily, it's Bitcoin miners. So we do work with a lot of off-grid miners, flare gas miners, as well as those who are venting methane out of landfills and creating some really unique solutions. And then again, we work with hedge funds and VCs who are investing in the space, as well as kind of your fintech companies are building some interesting software products. So that's what I do. Weaver's a top 30 firm. We're a big firm, so we're auditing, we're providing advisory consulting services, and really, helping companies build. All right, so off-grid mining. Let's see if we can get going. All right. So we're going to walk through the startup cycle, and really this presentation is designed towards your operator who is interested in this whole Bitcoin thing but probably doesn't know much about it, and maybe you're curious about launching a mining rig and what that might look like. And so obviously this is approaching it from an accounting and tax background, and then you're going to hear from the Martin Group about legal implications, and actual 3 operators who are doing this. So there's a 5-step phase, really starting with discovery, which, as you might imagine, you're kind of learning about the viability. Is this something that I can actually do? Is it going to be profitable? Do I have flare that matches kind of the profile that you need to run a mining operation? Then you move to the administration phase, where you're working on the legal side, building up contracts, getting your finances together. Move on to negotiation. You're deal making. You're dealing with all the people that you need to get your mine going, and then you're trying to make sure you're profitable. And 4th, you're building out your actual operation, and 5th, you're launching your operation. So let's dive into it. On the discovery phase, there's really 4 key points. Obviously, you've got to learn. You got to go and figure out this whole Bitcoin thing. I'm not going to talk too much about Bitcoin as a network or as an asset. I promised Drew Gunnard I wouldn't do that, the director here at NAPE. And we don't really have time for it because it's such a dense topic, but just know that this is a very interesting network. It's up and running 24/7, and basically you can mine it. You can choose to hold your Bitcoin on balance sheet, or you can convert it on the spot and sell it immediately. So you don't really even have to be interested in Bitcoin as an asset class to just realize that you can monetize your flare. You can monetize these wasted and stranded energy sources. And I think that in and of itself really speaks to a lot of the people here, because many of you are likely flaring. So as you discover, is this a viable thing? You really start moving into a planning phase. Yes, I want to move forward with this. Now what is it going to look like? And so on the accounting and tax side, where we really come in and help companies is we are advising on entity structuring. So perhaps you need an LLC and you want to do a joint venture with another operator, or a mining company comes to you and says, hey, I want to buy your gas. We're helping structuring the tax implications of making sure this makes sense for everyone involved. On top of that, we do state income taxes. So sales tax is always a big question. Do I meet the data mining center exemption? Do I have to charge sales tax? Or I'm converting my energy into electricity. Is there sales tax or severance tax involved with that? Pulling resources up out of the ground. So there's a lot of considerations. If you're in Texas, there's an exemption for severance tax that just got launched. So there's certainly some considerations in getting up and running, making sure you have all your boxes checked and your structure in place so that you're not doing things inefficiently. And then lastly is you can have tax credits for mining on flare, and that can look a number of different ways. It can be methane emission reduction credits, which are part of the recent Inflation Reduction Act. Now, really, you have to be doing this on a large scale. You can also participate in the voluntary carbon credit markets, which may or may not be an option for you. But I think more importantly is the research and development credit. So a lot of these companies are engaging in R&D to do engineering, or perhaps they are developing proprietary software. So all of these are tax credits, or all of these activities can potentially qualify for tax credits and make this a more profitable venture for you. And then, of course, if you're debt funded, or you have investors who require audited financials, if your operation is big enough, that's something we do for our clients. All right, moving on to administration. So legal infrastructure, I'm not going to talk much about this because Justin, that's really going to be his topic of conversation, as well as deal making. But on the financial infrastructure, so typically, you got to do your bookkeeping. You might have QuickBooks. You might actually have this as a sub-industry or subsidiary of your own operation. So you've got to figure out how you got to wrap all your books and financial records up into an entity. If you have employees, you got to think about payroll. If you're hiring contractors, these are 1099s. Got to get potentially insurance on all of your operations. And then I think importantly is selecting a mining pool. So mining is The way you monetize is you connect to often a mining pool, which aggregates all your computer power that you're deploying, and different mining pools charge different fees and different rates. So selecting the right one to have consistency in the flow of your operation is really important. And then there's also some interesting data analytics you can draw from your mining op, and really that's just for internal efficiency. Okay, so moving on to negotiation. So the deal making is an interesting aspect. Again, I'm not going to talk too much about this, but here are potentially the people that you want to talk to. Obviously, business partners, suppliers, vendors, the actual operators of flare if you're buying gas, or if you own your own, and you're partnering with another mining company, and the mining pools themselves. So all of these require contracts, and you've got to negotiate the terms of those contracts. You're probably looking at how much cost per MCF you can generate, or how much you can buy that for, and so this is a very important aspect of running a profitable mine. Then on build out, there are a lot of aspects to the actual launch of your operations. Once you decide, hey, there's this whole mining thing that I want to deploy, I've figured out that it's got to be in a container, I've got to pipe the gas or connect it to a generator, generate electricity, and then I've actually got to install all the computers, the ASICs, I've got to get satellite internet, figure out how to cool it, and then get software that runs everything. These are the main considerations of actually building out an operation. Then you finally launch, and this is really exciting, but now you've got to keep it all maintained, which is costly. You've got to monitor your machines, make sure they're up and running, make sure they're efficient. And then here's where really, we're coming in and helping our clients with preparing tax returns, doing R&D studies, cost segregation studies, advising on accounting, fair value, doing audits, financial controls, and valuations for your rigs. Okay, so I went through that pretty quick, and I did so because I kind of want to open it up for any questions for anyone in the audience, because a lot of this is pretty high level, and with only 20 minutes, I'd rather answer your specific questions than talk about the presentation. So, any questions? Yes, sir.
How do you determine what the royalty payment will be to the landowner on stranded gas?
Yeah, so the question was, how do you determine what the royalty payment will be to the landowner on stranded natural gas? And a lot of that is already papered up in your contract. So you would have to look at the rights and whoever owns the mineral rights, and then similarly to monetizing any other gas, you would be subject to those royalties.
The only way it's going to be produced is if we decide to use it in one of these machines. So otherwise, it's just sitting there doing nothing.
Yeah,
so the landowners getting, or the mineral owners are getting nothing right now. So how do we determine a fair price to pay him on something he's getting zero for right now?
Yeah, so the way you recognize revenue on a mining operation is that, and this really gets into the blockchain aspect. So the whole Bitcoin network is running 24/7, and it's made up of a chain of data blocks. So every 10 minutes, a new block is minted on the network, and the miners are the ones who mint those blocks. And so they are paid by solving these cryptographic algorithms. They mint a block, and then they're paid in what's called a block subsidy, and then also transaction fees. And because it's so robust now, you can pretty much get a fair market value as soon as you mint that block. And actually, your mining pools are going to tell you how much you earned. Okay, so that's how you determine how much money you've made. Then you've got to go look at the rights and whether you do owe royalties back to the owners. Does that make sense?
If you took the gas out of the ground, you're going to owe them a royalty.
Most likely,
Yeah.
yes. Yes, sir.
Can you elaborate how the mining pool works?
Yeah, so mining is interesting in that it's extremely competitive. So again, you have this chain of blocks, and the first person, or really the first machine out of billions or hundreds of millions of machines in the world, one of them wins the right to mine this block on the network. So you could think that it's kind of like playing the lottery, right? You know, if I deploy 100 million capital, I might only have a 0.0001% chance to mine a block. So the way that you actually create a consistent revenue stream is to operate with a mining pool and basically say, I'm going to contribute my computing power to this pool, and if the pool mines a block, then I'm going to split it based on my pro rata share of my contribution. And so that makes it a lot more consistent, and there's dozens of mining pools, but there are about 4 large ones that own anywhere from 15 to 30% of the computing power. So you can think that 1/3 of the time of every 10 minutes, so essentially every 3 minutes, you'll be paid for a portion of your computing power. Great question. Okay, any other questions? Oh, okay. The demand.
Shoot it up. Is there somebody there to buy it? And what are the long term?
Oh, yeah.
Is there somebody to buy it? And what are the long term outlooks for the price?
Okay, that's a loaded question. Is there someone there to buy it, and what are the long-term outlooks for the price? So first of all, I have to tell you, I'm not giving financial advice, but I have spent my 10,000 hours studying the network and where I think the price is going to go based on just the laws of scarcity and supply and demand. And I think it's going to go up pretty significantly over the next decade. Now, will there be periods of volatility? Well, just like oil and gas, yes, of course, it's a commodity. But yeah, so the demand is based on adoption. So who is actually using the network and who is deciding to interact with the network and buy the asset. This is a global asset. So it is available not just in the US, but everywhere in the world. And because it's a digital network, it's as easy as interacting with it on your phone. So, or your computer. So you can go and buy and sell Bitcoin immediately today, within a few minutes. And so if you're mining it, you can think about that you have this constant demand across the world for this product. Now, the price is an expression of supply and demand. So, you know, whether the price is down, that means demand is lower. And if the price is up, that means demand is higher. But it's kind of reached this inflection point where you always have demand. So yeah, as soon as you mine it, you can sell it immediately onto the spot market and get paid for it, convert it to US dollars.
Sorry, can I ask you?
Okay. Yeah,
One more?
take one more, sure.
Yeah, so 2 parts. One, you said about stranded gas. What about if we have a gas field and I opt to, instead of putting it into a pipeline, mining? So the benefits of the gas in the pipeline towards the society is not seen because you're mining it. Is that any stop from the government towards that? And then on taxations, is there any benefits on CO2 emissions or no? Thank you.
Yeah, so I'll take your second question first, and then let's revisit the first question. So is there any benefit on CO2 emission reduction? 2 years ago in 2021, or really 3 at this point, there was the Inflation Reduction Act that the Biden administration enacted into law. And that allowed for, or really created a lot of these new carbon credits or methane emission reduction credits. Now, to really realize those credits at scale or real money off of it, you have to have a very large scale of operations and be, doing a pretty significant amount of reduction. But yes, these credits are available to companies. So again, my clients who are doing this in landfills, if they can do this with enough landfills, that's a pretty significant amount. Now you do have to have engineering studies and to quantify the amount that you're reducing, and that's costly. But yes, it is possible. And then your first question, I'm sorry, what was your first question?
It was about, because you can choose to mine it straight away or you can put it on a pipeline, right? So if there any pullback from government to say like, well, if you put it on a pipeline, that gas is going to houses, so on and so forth, factories. But if you just mine it straight away, it's like, well, it's just for me, right? So is there any pullback on that or free to go?
Yeah, that might be more of a legal question or kind of a regulatory compliance question, as far as if you mine it, are you required to sell it back to a midstream company or through the pipe? I would say, obviously, yes, if you have a contract that requires a certain amount. But if, in the case of stranded or gas that's being flared, no, you don't really have that requirement. So this is just a wasted resource, and now you can mine on it. Yep. Okay. Well, thank you, everyone.
Thank you, Tim. I know there's some other questions. I encourage y'all to reach out to Tim and sidebar with him. Weaver and Tim are members of the Texas Blockchain Council. If you go to texasblockchaincouncil.org, we have a membership there. We'd be happy to make those introductions as well. I'll highlight two quick things that Tim said that I think was really great. First, there is a law that we passed in the state of Texas. It's also law in Wyoming that if there is gas that is being flared that doesn't have an economic use and it's redirected to commercial use, in this case Bitcoin mining, there is no severance tax on that, which makes sense. I mean, the state wasn't receiving severance tax before. Why disincentivize somebody to come up with an economic use for that gas? So that is law now in Texas that just passed. And as I said, it's already law in Wyoming. We hope to see it in more states. Tim also mentioned the mining pools, which is an important service to have a stable revenue stream of Bitcoin. And a lot of mining pools will help with liquidation into US dollars. And we have mining pools that are members in Texas Blockchain Council as well. So we just help to bring that network to anybody who's interested to actually get an operation up and running. I do want to make sure that we allow time for our next speaker, who's really got a great story, was an early pioneer in Bitcoin mining and has a great oil and gas background. Was one of the first, I think, if not the first, to mine Bitcoin in the state of Wyoming, to be part of deploying that operation. So we're really fortunate to have Justin Ballard, who's with the Martin Legal Group. And I love the name of this session, Bitcoin Wildcatting, Deal Making, and the Law. Justin, come on up here.
Thank you. All right. Yeah, that was the title of it, but I'm changing it now. Because no offense. All right, which one's forward? The green? No offense, Tim. The only thing probably more boring to talk about than accounting is legal issues. So, and I don't have enough time, and they're very they got to fit a little niche. So I'm really going to just talk about kind of the similarities between the two industries and kind of hopefully remove some of the confusion or lack of education that some people have on it, because they tend to build it up a lot worse. And the reality is it's not so different from what we do on a day-to-day basis anyway. My name is Justin Ballard. I am an attorney and landman. I've been doing oil and gas work since about 2010. In 2019, I was at a private equity-backed E&P operator up in Wyoming. And similar to basically everybody who's gotten in this from the oil and gas space, we drilled a well that we couldn't get a pipeline into. Wyoming has some pretty strict flaring regulations, and we were coming up against our hearing. I read an article about Steve Barber, upstream data guy, which you guys all need to meet because he's got some good products for you. But read an article about him and mining off vented flare gas or vented gas. I took that to our operations guy, and they literally laughed at me and told me to get out and stay in my lane, landman. And I didn't listen, and we brought a new operations guy in, and he luckily was on board with it, so we ended up putting a mine out there and started mining. This was back in 2019. I started doing some back calculations on what I thought we were making on a per MCF basis, and it turned out to be, based on my landman math, about $7 an M. When I took that to our ops guy, it turned out he told me we were doing $9 an M. So I was pretty excited. We were selling gas for about $1 an M at the time, and I thought, man, this is something I could go raise some money on. Did that, raised some money, started a company called J Energy. We ended up growing to about 9 megawatts on natural gas mining in the state of Wyoming. Did that for a while, ended up getting into closing some on-grid deals with some very large companies here in Texas, Texas Pacific Land. We did a Bitcoin mining deal out there, about 120 megawatts. And after that, I left and joined Martin Legal Group. I actually very recently left there, and I'm doing something else. So I reached my 18-month capacity on being at one place, so it was time for me to go. But I want to talk to you about kind of the realizations I had being in the industry and realizing that this is very similar to what you guys do, and we don't need to let kind of the Bitcoin name kind of confuse people or scare them off. This is something that you're all very familiar with, and you're going to be able to pick it up and run with it once you figure out the modeling side, really. Disclaimer, I am an attorney, but like I said, I'm not going to be talking about a whole lot of legal issues, but either way, don't listen to me, call your own attorney and figure out, the issues that are specific to whatever deal you might have. All right. How many of you in here have been approached by a Bitcoin miner to buy flare gas from you or stranded gas or any other asset? One. That's it. Okay. A lot of you are going to start getting more. They're also going to start approaching you. I'm closing a deal tomorrow that's a midstream-owned substation, and they had a lot of spare capacity. So a lot of this stuff applies to not just natural gas, but any spare capacity you have in your portfolio. But when you got approached, were you confused at all on how you model this out and whether or not you know if it's a good deal or not? Not initially, yeah. So a lot of people struggle with whether or not they're getting offered something fair or a good deal from some of these miners that are approaching them. There's a bunch of companies out there. To be very frank, there's not a ton that have don't have much experience doing a lot of this. And so making sure you're getting with the right partner is a big deal. But a big part of that is obviously being able to evaluate whether or not you're getting offered something that's marketable or within the realm of what you should be offered. These industries, there's a lot of similarities between not only the operational models, but the economic models. They're actually very, very similar. I'm going to kind of touch on some of that. And then the one that I think a lot of people too want to know about is the kind of the deal structure and how do we go about structuring a deal with a miner to make sure we're getting our fair value for what we're offering. The operational similarities, very similar to oil and gas, no lease, no grease. This industry, just like oil and gas, landman, you have the best opportunity to step into a Bitcoin mining operation and really kind of be paramount to their success. You have to have the land just like you do in oil and gas. The surface rights, you may have a well site with the Bitcoin mine on the well site. It might be somewhere down the line. I encourage everybody, you need to go out and get a surface agreement unless by some chance there's some clause in the lease that allows you to put that Bitcoin mine on the site. I've seen some of those. The first one we did in Wyoming, we actually felt like we had the right under the lease we had to put the mine on the site, and that's what we did under the production clause in the lease. So, but obviously that is going to be lease dependent, something you guys need to kind of consult with your attorney on, or call me and I'll come help you out for a small fee. But yeah, so no lease, no grease is the biggest part of making sure your operation is safe, and you're not going to have landowners come down the line and start trying to harass you about the operation going on the property. The other similarities, when people think about Bitcoin mining, they get confused a lot. The easiest way to explain it for me when I'm working with oil and gas companies, instead of a wellbore, you have an ASIC computer. And instead of producing hydrocarbons, you're producing terahash. Instead of selling those hydrocarbons for cash or USD, you're selling your terahash for Bitcoin. Everything else is basically the same in that model. You want to be the lowest cost operator to produce a barrel, just like you want to be the lowest cost operator to produce a Bitcoin. That's something that I think everybody in here can understand. It's a commodity price-driven industry, and so there's ups and downs and all that, but the bottom line is you need to drive your costs down as much as possible, which is why a lot of the gas that people are trying to buy, they're trying to buy below the market rate, but that's why it's typically stranded or flared gas. So it's not that you're not likely going to get the same type of revenues from this that you would selling it traditionally, although again, not to keep pumping Steve, but they have developed some kind of excellent models that I think you guys should visit with them about. So where you can get closer to a market price for your gas. Even the memes in this industry are the same. I know most people have probably seen this. It's the exact same for Bitcoin. We price everything in petahash or terahash. It's very similar. We're a commodity price-driven industry, and we have ups and downs, booms and busts, just like you do in oil and gas. The worst thing for Bitcoin miners, which is something as a oil and gas operator that I would ask you to please keep in mind when you're negotiating a deal, is there's no hedging market, not a very viable one anyway yet in the Bitcoin space. And so the ups and downs can be even more painful because you don't really have a way to lock in your long-term revenues off the forecasted production that you have. So it can be really ugly sometimes. We saw that in 22 when things came down off the highs and we had natural gas prices spike, and so your electricity costs went up a lot. Electricity is the number one driver of your OPEX, and so having a low power price is paramount for miners to stay online. You want the miners to stay online so that your production stays online. Typically, they're mining off associated gas, so we want to make sure that my production is staying online, and the way I got to do that is work with a miner. I've structured deals, I'll get into it, but I've structured deals in a lot of different ways based on the terahash price. The terahash price is like your price of a barrel of oil. So it's kind of the metric that miners are going to go by to determine what the value of their terahash is. Some other similarities, very heavily upfront, capitally intensive businesses. When you got an asset and you're drilling wells, I got 100 Haynesville well locations that I go and drill in an asset, you know how much that's likely going to cost you over the life of that drilling program. Bitcoin's a little bit different in that most of your CapEx is for the entire asset up front. It's very, very capital intensive. So that's a similarity between them. Another thing, and this is probably one that requires a lot more time than what I have to explain, but they both are dealing with decline curves. Oil and gas, obviously, everybody knows the decline curves. You're getting some hyperbolic drops in the first 6, 7, 8 months. Bitcoin mining is very similar. It might not be as hyperbolic drop, but as more miners come online and give their terahash to the network, the value of each terahash goes down because there's a set amount of Bitcoin that is produced every day. And so that number of Bitcoin produced every day does not go up. And come April, there's going to be what's called the halvening, and the production of Bitcoin will drop in half in one day. And so your revenue is basically going to drop in half in one day. And so that's something to keep in mind. They got a forecast in their models a decline curve because miners will continue to come on. We've seen a ton of growth in the difficulty factor for the network. And just like an oil and gas company, your production is going to decline over time, and so you're factoring that in on your economic review as well. So again, another similarity. It's something you guys are familiar with and you understand. All right. Which deals fit? The primary way that miners are approaching oil and gas companies are typically trying to buy stranded or flared gas. So it's just been a straight gas purchase agreement in a lot of cases. That's not always the case, but that's been a lot of the case. It's still the predominant deal structure that I think miners are finding with operators. There's more and more deals happening though where the oil and gas companies are wanting to kind of stay in on the upside in the event that Bitcoin rips. They don't want to feel like, we were selling this gas for $1 or less and Bitcoin rips and somebody's making $45 an M, like we were at one point during my time at J, and then they feel like they're kind of getting the shaft. Well, we don't want that. So on a number of deals I've done, we've tied in a terahash price mechanism for an additional bump on the price of gas or for a royalty of some sort. So there's a lot of different ways you can structure that, even within a straight gas purchase agreement. Again, I'm going to tell you all to call me if you want to talk about some of those structures at the end, but call me if you want to talk about it. Joint ventures, there's a lot more of that happening where people are contributing gas for equity or reducing the cost for a bigger bump on the royalty for the hash price. This is something where you definitely need to talk to your lawyer about and make sure that if you have royalty owners that you're going to have to pay on this production, you're QCing how that's going to work if you're doing an equity contribution or a gas contribution for equity, things like that. I would tell you in most cases, you are obligated to pay the royalty owners for the price of the price you sell the hydrocarbons for. And so that's what you're going to base your royalty on. If the market rate for that gas is $1, you're paying them based off that dollar. In this situation, it can muddy the water some. So be careful. Talk with your attorneys and figure that out. Self-mining. This is where a lot of groups like Giga, Upstream Data, some of the others that are manufacturing their equipment, they're selling equipment to the operator for them to mine themselves. I think I've seen more and more of that happening as well, where operators are like, look, we can handle this. We can do it ourselves. I would tell you, it's not as easy as it sounds. Like I'm just plugging a computer into some power and turning it on. There's a lot more that goes into it, and that's where groups like 360 Mining, some of the other ones out there, Verde, there's a lot of them out there that are good quality Bitcoin operators. You need to visit with them. Make sure you're comfortable with it. Don't take it for granted. I've told miners in the past that think they can just go out and buy some wells and just plug in their miners off of a generator. It ain't that easy either. So, respect the knowledge of both disciplines and both industries, and kind of make sure you're running your bases and checking everything before you go and dive in, because it can get heavy on the capital side. Let's see, what else do I need to touch on here? Think of this as a digital midstream. That's the way that I describe it to a lot of operators, that this relationship typically is no different if you're selling gas than you would be selling gas to a midstream company. It's a digital pipeline, a digital midstream group. It's the easiest way to explain it. And also, again, like I touched on a little bit ago, don't overlook the opportunities to sell power from underutilized capacity that you have. The deal I'm closing tomorrow, they had built a substation out to 25 megawatts. They've been using 5 megawatts and having to pay a hefty surcharge to the utility company because it was built by the utility company but owned by them. This deal is going to not only make them money from a surface lease and a potential royalty, depending on the hash price, but it's also going to save them over $70,000 a month in charges from the utility. So this is an excellent way to go into a quick agreement like this. They're basically doing I want to call it a gas purchase agreement. It's basically just a surface lease to access the power. And then they're going to realize about $1 million a year just from having somebody come in and take up 3 acres. They're not drilling on the property. It's a very easy operation. Once it's done, they can pack up their containers and they leave. So it's a very useful application. It's an excellent way for you guys to increase revenues, and it's really something you really understand. So it's not as complicated as people make it from a deal structure side and what it is. If you got any questions, call me. I'm working with a lot of oil and gas companies, ranging from very small mom and pop shops all the way up to some of the big public companies. Really just coming in and educating them on the models and how to actually do the economics on it and what it looks like, so you can evaluate what kind of deal you want to do and what makes sense for you, and walk through operational issues as well. So, that's it. Anybody got any questions? Yeah. No? Yeah.
Essentially, what's the difference between bringing on a Bitcoin miner and selling your gas to them versus maybe just getting a power generation set up and just selling your gas through the electrical transmission lines?
You can do that as well. I think the problem I run into on your lease side is that you're selling it on an electricity basis, right? What's the royalty going to be calculated off? That's something that can be done, though. You can go back and calculate it. In those situations, depending, if you look at your numbers and look at the economics, if it's more advantageous to do that way, paying a market rate on the gas for what the gas would have been, I've had people doing that. So like, look, it's more advantageous for us to convert to electricity, sell it, and I'm going to pay my market rate on that gas. Again, you need to talk to your attorney about what it is and the specifics of the lease, but there's ways you can do it. But that would be the issue I would say would pop up potentially. Anybody else? No? All right. Thank you, guys.
Thank you, Justin. Hey, y'all, we're really fortunate to have Crusoe Energy as not only a sponsor of the Bitcoin Mining Pavilion, but also one of the companies with some of the most success in deploying this at scale in the oil field. So I think we're fortunate to have that testimony. And Andrew Likens from Crusoe is going to present on that subject of their digital flare mitigation technology.
Oops, can I go back? Hello there. Good to see Justin. We did a deal when he was at Century in 2019 on a stranded well up in the Powder. And so it's great to see the industry growing. But yeah, I'm Andrew Likens. I am the VP of Business Development for Crusoe Energy. And I'm here today to talk about how this technology can be used as a development tool. I think a lot of folks can tell you how exactly it happens, can give you the details and the mechanics, but I want to focus on the value that it can provide for operators from a development flexibility perspective as they execute their drilling programs. So quick rundown on Crusoe's growth. We take the service model approach. We provide digital flare mitigation as a service anytime gas is stranded, and for a wide variety of reasons that we'll get into. But Crusoe is now in 5 basins. We entered the Uinta and the Permian last year. We have a couple manufacturing facilities. We manufacture our own data centers as well, and we're also in Argentina. We operate over 200 data centers, 300,000 horsepower, and have raised over $1 billion to date to continue to grow this business. So this is a topic that's near and dear to my heart. I started my career on the upstream side, like a lot of you guys. I think my career, I was a land manager at Camino Natural Resources, NGP-backed Midcon player immediately before Crusoe. I was a landman at Triangle prior to then, and so I've really always looked at this tool as a way to improve kind of flexibility for operators in drilling programs. And in each one of those situations, we were running 4+ rig programs, and when you're sitting there trying to clear DSUs, it's really challenging. You face a number of which drilling units are ready to go. You have regulatory issues, you have surface issues, you have facilities issues, but one of the most prominent ones was the gas takeaway challenges. And I think Crusoe has really proven with the digital flare mitigation technology that it can be leveraged as a way to navigate some of these gas takeaway challenges where production and takeaway capacity might not always be in line. And so I want to share with you today a few of the big projects that Crusoe has taken on that's helped operators navigate some of these challenging scenarios. So this first example is, delineation prior to pipeline build. So you have an asset, it's a step out, it's going to require significant midstream build out. Are you going to sign up to a big midstream contract with minimum volume commitments right off the bat? You don't really know what you have in that resource. So folks want to drill a few wells, delineate that acreage. How can you do that in a way that's environmentally responsible and creates value for you to negotiate a more favorable midstream agreement in the future? You leverage an alternative offtake solution like digital flare mitigation. Types of digital or downstream infrastructure constraints. There's basin takeaway issues like we've seen in the Uinta this year. There's gathering system or compression shortages in kind of the micro scale. So how can we kind of plug in and be a tool for gas offtake in some of those scenarios? And then even right-of-way issues. If you have a problem surface owner, we can't run pipeline, we can't get a permit to run pipeline, how are we going to produce this pad? And so those are just a few of the ways, including off-spec gas production. If you have high inerts, not pipeline spec, going to cost a lot of money to treat it, Crusoe can consume that gas, assuming the BTUs are there. So this first example is in northwest Colorado. It's the North Park Basin. DJ geology, great geology. They're drilling some fantastic wells. The only challenge is they're 60 miles away from any material pipeline. And so their gas takeaway is basically nothing. So how can this company commit to building a 60-mile pipeline without really kind of proving that the volumes are there and committing those volumes to underwrite that pipeline? And so Crusoe has deployed about 5 million cubic feet a day of capacity today, which is about 32 megawatts of power generation and data center load to basically help this company produce the oil and manage the gas in order to validate that the resources here, the dollars are coming, and we can underwrite this pipeline. So this is a way that we can help bridge the gap between initial delineation and future permanent takeaway infrastructure. This downstream infrastructure constraints scenario. I don't know how many folks are paying attention to what's going on in the Uinta Basin, but it's amazing. The XCLs and Oventivs of the world, they're drilling prolific wells that are competitive with the Permian. And they're looking at their development schedule last year, and the basin-wide takeaway hasn't kept up with the development pace. They're going to be 5, 10, 15 million a day short on takeaway from the basin. So what are their options? They can curtail oil production, they can disrupt their development program, or they can tap on Crusoe. And Crusoe has showed up for the basin in a big way. We've deployed 12 million cubic feet a day of gas takeaway infrastructure. This photo right here is about 6 million cubic feet a day. It's a Titan 130 and 10 2-megawatt Waukesha's. This is about half of our capacity. We have 2 other 3 million a day sites. So we've materially expanded the gas takeaway capacity of this basin to allow these operators who are drilling amazing wells on the development pace that makes most sense for these companies, and they're able to maintain that and execute on producing that asset. Next is a gathering system scenario. So this is an eastern Montana situation where there are great wells on that eastern side of the Bakken. Their only mistake was being on the wrong side of the basin from the gas market in Chicago. And so it's really hard to get adequate gas takeaway infrastructure in this eastern Montana area. And so they were having additional capacity, compression capacity built, but they knew that their development plans would kind of far exceed that compression capacity. So we worked with the operator to build an infield gathering system and consolidate to a central point where we've deployed about 2 million a day of gas takeaway capacity to allow them to produce the oil and develop the asset in the way that kind of makes most sense in the face of kind of less compression than they really needed to produce this area. And finally, we have the right-of-way constraints. This is a site on the Fort Berthoud Indian Reservation in North Dakota. It's incredibly challenging to get right-of-way on the reservation to build a pipeline. But funny enough, it's some of the most prolific acreage in the basin, and a large public operator had drilled 5 Tier 1 ducts, and they couldn't get their pipeline built. So they needed to figure out a solution. How can we responsibly produce 5 Tier 1 ducts with no pipeline? And Crusoe partnered with a CNG and an MRU company to basically provide a comprehensive gas takeaway solution for that 5-well pad in the most responsible way possible to mitigate and minimize flaring as much as possible. So this is a site that we're really proud of because we think this is the best-in-class way to produce an area without existing pipeline infrastructure. And so this is another one of our Titan 130 turbines and some Waukesha's, about 3 million cubic feet a day of takeaway capacity. So these are just a handful of ways that we believe that this technology can help operators produce their assets most effectively. That's what we're here to do. We're here to provide that flexibility. The existing flares are kind of the low-hanging fruit. Of course, we'll come in and help you mitigate that flare, but we want to be involved on the planning side, on the development side up front, because we really feel like we can create value for operators in that way. And I think the education and learning curve has really started to advance, and we're seeing some really creative applications in the Permian and elsewhere of our technology. So I think that's something we're excited about and happy to talk to anyone about any sort of creative situation. And then before I let you go, I think if we take a step back and think about what Crusoe is really doing here, we're deploying load to areas of excess or stranded energy. We're utilizing that energy effectively in a way that it has never been able to be economically utilized before, and Bitcoin is an amazing tool. There's the interruptibility of it allows for emissions mitigation unlike any other. But Crusoe in the background has also been developing a high-performance compute cloud. So we have a kind of GPU-focused modular data center, actually multiple deployed in eastern Montana that train AI models and provide sort of energy-intensive compute workloads outside the Bitcoin ecosystem. And this is an area of growth, obviously, across the country, but for Crusoe as well. So keep an eye out for more growth on the Crusoe cloud front. But yeah, appreciate you spend some time with us today, and yeah, looking forward to talking to you about your stranded gas challenges. Thank you.
Well done, Andrew. Thank you. Hey, like many of you, I'm a proud native-born Texan. I think that there's no other place that stands to benefit more from deploying Bitcoin mining in the oil field than Texas. But even within Texas, I have to say that nowhere could be a better place to see a transformation that this technology can bring than Midland. Our next speaker, Paul Cockerham, is a Midland native and started Verde mining in Midland and is actually starting to build and deploy this there. And it's a great story. We're fortunate to have Paul to speak a little bit more about the work he's doing out there. Paul?
Might just have to hold this. Okay. Good afternoon, everybody. My name is Paul Cockerham. I am the CEO and co-founder of Verde Mining. I want to give you guys a couple pieces of information before I get into my presentation. I am going to tell you things in here that are financial. It is specific to our site in the Permian. Granted that this is scalable across all of your regions. Don't take this for the Bible. Take this for the opportunity that it is. This presentation is not for the Bitcoin miners out there. Everybody who Bitcoin mines right now is already pretty much familiar with this process. What I'm aiming at is talking to you operators. If you have an asset right now that is stranded, flared, sour, or you're waiting on compression, then this is for you. This is going to be more geared towards, if you are getting approached by folks like me, what should you be asking of that party? What do you want to see on your locations? And if they're not asking or answering these questions, then I would say just be of concern. So, without any further ado, there was a time when it was sensible to ask whether Bitcoin was a fad, a plaything for technologists spending too much time in their basement. That time has passed. Market capitalization of Bitcoin is now over 800 billion. And over time, when we zoom out through a log scale, the price per Bitcoin has showed a consistent upward trend. If you don't believe me, just look at the brand names that have launched ETFs in anticipation of the continued growth of Bitcoin as an asset class. Bitcoin mining in the oil field. I hope to convince you today that Bitcoin mining in the oil field is happening at scale in the United States. The process is well understood, and I want to take you through that process and some of its desired economics. This is a three-step process. It's pretty simple. Firstly, you have a fuel supply. The gas supply requires appropriate metering to ensure that the operator has complete transparency and confidence in the volume of gas being consumed daily by the mining operation, which may be the very basis of that commercial agreement. Secondly, you have generating electricity. It is a key that your team is properly sizing the engine and to the volume and rate of gas, while choosing the appropriate equipment necessary for the composition of that gas being offered. There are a wide range of manufacturers and models to choose from. In this picture here, on our site, we have a Caterpillar. It's just your common Cat G3412. That would be putting out about 400 kilowatts. And over here on my fuel supply, you're going to notice a two-phase separator. That's standard. Once we take custody of your gas, you're going to want to know as an operator that I have all liabilities on my end to compensate in case of anything that happens. The two-phase separator is there in case that you as an operator have maybe your dump valve stuck and you send me liquids. I don't want liquids at my engine. I want my engine to run 100% of the time. And for this facility, it's on flare. So this facility is intermittent. So it does this all day long. And I can't afford to be out there every day turning the engine back on. So this unit has to ebb and flow with your operation. So having that custody line going through a flow meter, that flow meter is tied to this unit, which is tied to the container, and will turn on and off based on available gas from that operator. This system too is 480 volt, which we're all used to. We will derate that down to a 415 for the actual Bitcoin mining. Lastly, you have monetizing the electricity by mining the Bitcoin. A physical on-site container filled with mining computers specifically designed for mining Bitcoin. There are a range of engineering considerations for the design of the container. Its electrical and cooling infrastructure, not to mention the choice of mining computers known as ASICs that you would be running. Critical to those considerations will be your physical location. What sustainably works in the cooler climates of northern Canada will not work in the Permian Basin, okay? So this is a Texas edition that I had designed for the hotter climates of the Permian. This three-step process will deliver economic value. As you will see, while the economics will always be specific to a site, I wanted to share with you some indicative numbers of the revenue and EBITDA, where the incremental CapEx is relatively modest. While there will be volatility to these numbers through the economic cycle, we can have real confidence that there is meaningful value to be had. Referencing this pie chart, we estimate that 62,000 MCF per day is currently being flared or consumed by off-grid mining operators, where there is a further 740,000 MCF per day that is being flared in the United States alone. We know that a significant portion of that is here in the Permian Basin. Now, I'm not suggesting that all of this flared gas will be economic for Bitcoin mining in the oil field, but most of it will be. I expect that regulatory constraints on flaring will only grow in the medium term, which will serve to accelerate adoption of Bitcoin mining in the oil field. And apologize for my sweating. I don't know why it's so hot up here. And you are not alone in seizing this opportunity. What was an experimental industry 5 years ago has matured quickly. There are now many proven mining operators right here in the United States that can support you in taking the next step. I have cherry-picked a few of those companies here, and I expect that many of them will be at NAPE this week to answer any of your questions. I am sure that I speak for my industry peers in arguing that friendly competition to provide the best service to you oil and gas operators is our utmost importance. Operational considerations. Like with all industrial processes, there are nuances in implementation which require multidisciplinary approaches to solve. As you reflect on who is the right partner to work with, or indeed if you wish to internally build this capability, I wanted to call out 3 specific considerations. Number 1, longevity. Will my mining solution last as long as my wells? In most situations, gas production will decline over time and may have intermittency in production. Your mining capabilities need to anticipate this vulnerability and this variability of gas production. To do so, they must be literate in reserve economics and decline curve analysis so that they can anticipate and respond both on your site and across multiple. Number 2 is going to be engineering acumen. Am I working with a specialist at mining Bitcoin in the oil field? Mining in the oil field requires competencies that straddle what has historically been 2 very different fields. You need to ensure that your operations team has the appropriate skills across 2 domains. For example, you'll need an operations team that has the capabilities to maintain generators appropriately, which is so critical for ensuring utilization. As we all know, assets like generators will require maintenance at least every 500 hours, with deeper maintenance coming at 1,000 hours. And this is every month of continuous run. If you're not taking care of your engines, you're going to go down. Field ready. Is my mining solution unlocking hidden value or adding risks? like all engineering solutions, there are risks that need to be understood. This is kind of a cool one because in our situation, the risks that we had was if the generator turns off, where does the gas go? If I don't have an outlet for that gas to go back to the flare, then not only am I going to shut down my system, I'm going to backfill pressure on the facility. So under no circumstances do we want to put back pressure on the facility or let alone downhole. What we have noticed on our facility is that when we run and we're eating all that gas, the operator is getting like a 1 to 3% production increase because there's no bottom hole pressure. We're taking all of it. And the facility is running at like 20 pounds and nothing gets stuck, nothing gets tight, and we're not taking on liquids. And as a result, that operator's like, hey, thank you, we're getting more oil. So keep it up. I would hope and expect that in dealing with any mature mining partner, the 3 operational considerations of my prior slide would be more than satisfied. Now I encourage you to go a step further in your due diligence, where I suggest there are a further 3 considerations which may fully optimize your in-house operation. Does my mining solution monetize carbon credits? Recent innovations in accreditation of carbon credits from methane mitigated by Bitcoin mining in the oil field suggest at least $1.50 per MCF of revenue is achievable in today's market. That is a benefit over and above the numbers I have shared with you previously here today. The process to achieve this outcome requires specific capabilities in navigating the accreditation process for the carbon registry and subsequent monetization in that marketplace. I encourage you to stress test your partners and internal teams on their capabilities to achieve this value. Beyond the economic incentive, we also know that achieving carbon credits in your operation will help your environmental branding. Now understand this, $1.50 per MCF is if I am selling my carbon credits in the United States. Our program, we are with the Verde registry. Within the Verde registry, I can sell my carbon credits across the UK and the EU. If I'm selling my carbon credits into the UK, I am going to realize $4 per MCF. So again, that's above and beyond what the Bitcoin does for you. Do they have the experience and qualifications to handle sour gas? While the quality of gas is site-specific, any operator here in the Permian will be conscious of whether their gas is sour or indeed the risk of their gas becoming sour. There was a time when sour mining operators would say that sour gas was not consistent with reliably generating electricity on site in a cost-effective way. That is unambiguously false. Given appropriate engines and engineering practices, your mining operation can monetize sour gas. I have an example for you. Waukesha, they're a manufacturer of Rankine cycle generators, just like the Caterpillar that you saw. The difference is the Waukeshas in continuous run can handle sour gas up to 800 parts per million of continuous run. So you don't need to go down the path and go capstone and get those crazy microturbines. You can stay with a Waukesha and keep the same style that you've always been used to, and you just may not have noticed that you don't need to take your gas down to 0. You could keep it at 800 parts per million and just run it straight through the engine and just produce the electricity the same way I am. Your mining operation brings a scalable power solution to your site. Consider whether there are other uses for that electricity which would be more cost-effective or more timely while you await grid connectivity to support your operations. Power for your wells, power for water transfer, desalination, lease-wide microgrids, and on-site 5G networks where 5G doesn't exist are just some of the options that you have at your disposal once a mine is out on location. And that is all I have. Thank you very much for this time. If anyone has any questions, please, I'm happy to answer some questions. It just depends on how technical. No, that's good.
Thank you, Paul. We have one more presentation from someone I'm really glad to introduce, who's a great Texan and has been a consistent voice for the oil field getting more involved in Bitcoin mining. It's a great story and background that he has, and I'm really happy to invite Griffin Haby with his trademark hat to come on up and tell us a little bit about his background.
Thank you, sir. My background, I'm Griffin Haby, landman since about 2005. Worked all over the country, independent, running title, chasing leases, buying minerals, all that good stuff. And I basically ran into one of my buddies in Lubbock, and in the middle of catching up, he says, what are you up to? And I kind of half kimonoed. I was like, well, we built this algorithm that we're buying royalties with. I said, what are you up to? And he kind of half kimono. He says, I'm mining Bitcoin off natural gas. And I was like, we'll take 4 margaritas. Let's go. And so we just got into it. Basically, he opened up, told me this stranded gas. He's a geologist. His dad's a geophysicist. They have a seismic company. And they're out there banging prospects, mainly Central Texas, hitting reefs, and 60 barrels a day, 100 barrels a day. They just need one of those a year. It's a great little business. So they hit this one well, and they're thinking it's going to be oil, liquids, because there's no infrastructure out there, and it's a dry gas well, so they can't, truck the gas out. So it's mainly about a BCF of reserves, so it's not enough to justify the economics of ever building that pipeline, and even more, it's 19 miles for the closest piece of pipe, and then they got the gas tested, and they had high nitrogen content. So basically this well is dead in the water, and they have to get creative. You either fill, the well bore up with cement, call it a day, go for the next prospect, or they talked to Steve Barber out of Canada, and they designed a Bitcoin mine to where they got all these, containers, filled them up with computers, and instead of selling that gas for $0, he was able to make $9 an MCF. And this was when gas was trading at $2. And I could never unsee that. And my real aha moment into the business came from learning that. I said, I want to get involved. What do you need? So we basically did a friends and family raise. He was running some old school S9s as a newer, older generation computer, called it like a Ford Pinto, and he needed some Ferraris. So we basically got these machines in, and kind of the rest is history. We got a grid site as well, and we're able to kind of divest that company. And now sold those assets, and now we're back under Mountain Line Mining, and we are looking to grow and expand. Do I have like a clicker, or how do I change that?
Sorry, man.
Just hit this thing. Hello? Green. Am I pointing at anything? Oh. So for the first time in history, man has a new technology application that solves a problem that has plagued the oil and gas industry for decades. Bitcoin mining can provide a profitable and sustainable way of utilizing the excess natural gas that is often flared or vented at oil and gas sites. I'll teach you how to Bitcoin mine and the opportunities for landmen. So my little claim to fame is I was the quote-unquote expert witness for the Texas House of Representatives on this bill that just recently passed. It was HB 591. And what it did was it gave the oil and gas operators in the state of Texas clarity on what to do with either flared gas or vented gas. They now will pay 0 severance taxes if you mine Bitcoin off of these molecules. And so what I really think that did was, sure, this isn't going to move the needle economically for an operator or for the actual Bitcoin miner wanting to do a project, but what it really does is it sends a signal to the rest of the world that Texans are, free market capitalists. We can solve problems, through new technology or just basic old Texan ingenuity, and we don't need extra regulatory, government hamstringing us and telling us, what we can and can't do to make money. So anybody in the upstream business knows that you explore, produce, and market. And what happens when you can't market? That's kind of where we come in here for Bitcoin mining. Usually, storage, it's super expensive, or you need a salt dome, to really store that gas. Well, you can't really have that geology in place when you're out wildcatting. That's the last thing you're worrying about. Flaring, producers can flare for now, and in some states. We saw North Dakota and the Bakken really hammered back on flaring, and that's what really created this industry. We saw New Mexico has now done it. So there's more demand for people that are trying to produce oil, but they can't get their oil off of the lease because there's all this associated casing head gas that they need a market for. They don't have a market. They're waiting on pipe. Well, now that they have the ability to use that gas to make electricity, to then get Bitcoin, it's not only an economical decision, but their main business is trying to sell oil. And so that's what really the problem solving comes in. And then obviously, if it's a pipeline, you want to do that. But sometimes you have capacity constraints. Sometimes the pipeline is bending you over because you're not the only game in town and they are. Or their differentials are so bad that they say, you're going to pay us to put this gas in there. And it's basically one more arrow in your quiver that you can negotiate back with the pipeline and tell them, hey, kick rocks, look what I can do. So basically, stranded gas is now no such thing. You can monetize gas anywhere in the world, and you think about all these different fields and all of your portfolios and every upstream company here, you've had this problem where you've got this stranded gas, whether it's a price, whether it's a lack of infrastructure, and you've never had the ability to market with absolutely zero out there, until this came along. So I'm sure everybody else has talked about Bitcoin, since I've been up there, but you think of it like a commodity. In the Bitcoin mining, it's very similar to natural gas markets. You can chug along for 10 years, but you really made your money last year and in 2005. Like that paid for everything you've ever done in natural gas, but you had to be online. You couldn't start drilling and really, make up for that money. So the goal is to be online hashing when the Bitcoin price spikes, and then you're able to realize all of your paybacks and actually, start profiting during those things. It's a 24-hour spot market, so you don't have to wait on weekends if you're trying to hedge or anything. It never closes. Proven track records, just been growing and growing and growing. There's only 21 million, which all of us in this room that knows how to produce a commodity, it's a very difficult thing to do, and it's the more resource out there is obviously always going to affect supply, demand. With Bitcoin, there's only 21 million, and that's all there will ever be written in code, so you never have to worry about a new gold mine or Jerry Jones drilling a massive monster Cotton Valley well and flooding the gas markets, right? And so basically what we can do is the simple math, which I'm sure everybody's talked about, is 300 MCF is going to get you 1 megawatt. 1 megawatt is about 240 of these ASIC machines, the actual computers. And then from there, you can say between, call it 2 Bitcoin a month. And for something that you were lighting on fire, all of a sudden being worth, today's trading for 43, so 86,000 bucks that was just a flame last month is, quite interesting when you actually look at it at the economics level. So mining in general, the transactions are pooled together. So if you think about it, I always go back to the oil and gas side, is where you have a proportionate interest, right? Whether it's a working interest or a NRI royalty, is so when you put your machines onto a pool, you're basically adding your horsepower or your computing power inside the pool. And when somebody finds that block, you're getting paid a proportionate interest of those block rewards, which are now 6.25 Bitcoin, which is going to be 3.125 Bitcoin, say in like April. And so when your pool finds a reward, you get your proportionate interest on that. So yeah, basically, the Bitcoin miners are really securing the network. The beauty of Bitcoin is it's a trustless network to where you really don't have to rely on, I'm sure nobody's ever done a shady deal in the oil field, besides my first time I bought a working interest, but it happens. The beauty on this is totally decentralized. Somebody can't wake up and decide, hey, I'm gonna print more coins, like a lot of these other scammy coins. Truly decentralized, to where you have to trust nobody. The computers, how much horsepower you contribute is basically what you're going to get for your rewards each month. So the more, basically the more computing power that you put onto that network, the better your odds are and higher your rewards. I guess I'd skipped over this the basic economics, nat gas, turn that into electricity. Electricity then goes to these ASIC machines to where you have your hash rate. And then what's fun about the oil and gas industry is deal structure, right? Everybody grew up with a third for a quarter. We had a standard lease form called a producer's 88, and we just kind of did it. That's because how dad did it, or that's how granddaddy did it. Now we are in this new, basically infancy stage of a brand new business to where deal structure is wide open. I talk to guys that just say, hey, just let me sell this gas to you. Give me $1. Give me 50 cents. Just, I don't want to have anything to do with whatever comes out on your magic digital beanie babies, right? They just take the gas. It's better than a zero, what I was getting, right? Now you're starting to see people get more curious, and they're really starting to see, holy shit, this is not just a tool. This is making a huge problem that we had just non-existent. And so they want to get, more involved and say, hey, how about, I got field hands out there every day that are, pumping these wells, and, that SOB is pretty damn good with the generator. He's got a mechanical brain. How about I, maybe get involved on the operation side? How about we split the OpEx, split the Bitcoin, and next thing you know, you're getting these guys that are coming into the business, and then they're holding Bitcoin on their balance sheet. And if you don't have to sell, it's great to hold, right? So the perfect storm, in my opinion, for the oil and gas industry is high oil, right? So you got this increased cash flow. Everybody loves $70. Low gas, which is where we are today at $2. So you just have less marketability in general. And then what has usually been a big CapEx hurdle is buying these machines. The equipment is not cheap. But right now, you can actually, because you're in a Bitcoin bear market, you can get these machines at like rock bottom prices. When we first got into it, we were paying $4,500 a unit. The second batch we got were $7,500, and then it went all the way up to like $15,000, $20,000 a unit. Now you can buy these things for $2,000. And so it's almost a just beautiful, perfect storm to where the upstream oil and gas guys, with that extra cash flow, with less markets for their gas, and it's just a great time to where it's not as big of a hickey when you're writing down your machine's cost, that it makes a whole lot of sense, and a lot of people are starting to take a closer look at it. And then I think we're like in the very beginning. I had to throw a meme on here because I'm a Bitcoin maxi. But right now, you're looking at it like, oh, hey, this is a nifty tool to monetize my wasted gas that was literally giving you zero. Then next thing you know, you're starting to look at a field entirely differently. Like, why would I buy that, Western Australian Canning Shale property when I'll never have a pipeline out there in my lifetime? Well, next thing you know, you don't need a pipeline. And so stranded energy is just not a thing anymore. You've got this new technology that gravitates towards all stranded energy assets because that's going to be your cheapest power. High supply, low demand. And then once you really get into it and understand how the petrodollar history of governments manipulating their own currency, you're gonna start wanting to instead buy sell your oil and gas for Bitcoin instead of the US dollar. And that's all I have to say about that. Any questions?
What's up with that? Yeah.
Oh, how do I go back?
Can you just real quickly explain what kind of players would be optimal for flare gas?
Yeah. So when you're running the flare gas, gas quality is always going to be a big deal. You don't want too much, liquids that you're having to strip out. Sour gas content. So a steady supply and good quality is really, what you're looking for. But I would say the need is the most important thing. If you're sitting here with, 800 barrel a day well, and you can't get that to market because all this casing heads gas is going to come out, and traditionally the only way we can solve that problem is, not venting methane, but lighting it on fire to where we can actually move that oil out. And so those are the guys that need that cash flow from the oil that really, look into this out of necessity. And then once you really look into it, it's really hard to unsee what this world is. Very mobile. They're basically picture of, 40, 80-foot container that you see everywhere, shipping container. And you can basically pick that up and travel. A lot of the guys were doing it following the rig to where, you're waiting on the gathering lines, you're waiting on the midstream to where you're drilling for oil, producing that oil, but have that access gas that you can then mine it with there and then on to the next once you get that pipe tied in, and then you're just following the rigs with your units. Thank you all very much.